Take it forward with Mr. Abhay Agarwal, the founder and fund manager at Piper Serica, joining us on the show right now. Abhay, what's the expectations from these two mega events, earnings and budget?
Yeah, good morning. I think on the earnings side, we're not expecting any major positive surprise, frankly, because the data shows that there has been a slowdown in domestic consumption over the last 3 months, starting from the festive season. So unless the data changes, it doesn't look likely that we are going to see any positive surprise of a big kind. In fact, as we saw, the earnings expectation for the Nifty was downgraded more than what we expected in the last earnings cycle. We expect that while the intensity of downgrades will not be as high because this time the expectations are not as high, still there will be downgrades, further downgrades. So we expect that the earnings season will end with some bit of overall disappointment on the earnings growth. What will be interesting to see, Anisha, there is the management commentary. What are the managements of some of the industry leaders, especially in banking and financial services, in FMCG, in autos, and other consumer discretionary products are guiding towards in terms of demand environment. It will be interesting to see that. On the budget, Anisha, I think this is again a remarkable opportunity for the government to fix a lot of slowness in reforms post elections. I think the market participants and investors, even the long-term investors, are a little disappointed by the slow pace of reforms, especially related to taxation policies. So there is expectation from us that the government will use this budget in a manner that unleashes, what are called animal spirits once again, and brings back a virtuous cycle of capex, consumption, and investments and returns for investors. So expectation from the budget are much higher and positive than the earnings, I would say.
Hi, Abhay. This is Ankita also joining in. Abhay, is the market then likely to remain sideways for the next few months? Given that the next quarter earnings also look subdued, and when can the consumption see a revival, especially the urban consumption? Given that we are expecting the private capex and of course through the budget, the capex to pick up now.
Yeah, I think Ankita, to answer the second part of your question, which is when do we expect a revival in consumption cycle? Probably 3 to 6 months away, because it does not look like a structural slowdown. It just looks like a cyclical slowdown. We have seen a pretty sharp uptake in consumption across the board post-COVID. So I think some bit of slowdown there is expected and acceptable. I think it helps companies consolidate and come back stronger. But any slowdown beyond 6 months would worry the market participants, because then it will start looking like a cyclical slowdown. And I think this is where the government and to some extent RBI have their work cut out. To get consumption going, they need to put more money in the hands of consumers. And that is only happening through subsidies and grants in some manner, not through rationalization of tax rates. It's not happening through reduction in cost of capital or cost of borrowing. The EMI costs, like to like on a year-on-year basis, are higher for buying autos. It is difficult for people who have less than 680 CIBIL score to get any loan at all now. So I think that tightness has to go away. I think for the consumer demand to pick up, some structural changes have to kick in to boost that consumption. They are not visible right now, but I'm hoping that the government is very cognizant of that and starts looking at that in the budget and maybe before that also. On the markets, yes, we are expecting that the markets to stay in a tight range of, say 23,000 to 25,000, because there are no triggers for the market to break out above that. And there are really no reasons for the market to go into a deep correction also. So I think it's an opportunity for investors to pick growth stocks at a reasonable price while there is low expectations by the market participants.
Sure. Okay, so the headline index is expected to be sideways and range bound, but as you said, it's about stock specific action, right? So Abhay, what have been you doing of late? Which are the stocks that you've added or something that you've trimmed your position on?
Anisha, we have been on the overweight side. We are overweight in insurance. We believe that this is a large space that has not got its due for a long period of time, and for various reasons, a lot of them do with distribution presence, cost, and also the pricing and the product innovation. But looks like slowly things are changing. IRDAI seems to be more friendly. We expect to see more innovative products come in into the market. The market is also consolidating very rapidly with the larger players. So insurance is one space we are fairly positive on as a market outperforming space for year 25. And again, these are not buy recommendations. They are in our model portfolio, so they are public information. But stocks like HDFC Life, Lombard, ICICI Pru, and Star Health are some of our picks there. The second space that we are overweight, we have been overweight on for the last year, is large cap pharma. And again, with the thesis that this is a space that has done a lot of hard work, and investors were disappointed for a long period of time, but now the whole space has picked up. The companies are getting rewarded for generating the large product like pipeline that they have for launches in the US market especially. And the US FDA is also quite friendly because they need generics from India. So I think it's a positive demand environment. The pricing power is slowly coming back. So I think these are the two large spaces that we are positive on. On the negative side, where we are underweight on for the time being, because we think that the near-term growth will disappoint, is banking and financial services space. It's a large space which is very important for the GDP growth, but we believe that there are structural issues and some of the headwinds that the sector are facing are going to become worse over the next 3 to 6 months. So banking and financial services is we are underweight, and we are also underweight on consumer discretionary demand spaces like autos, paint, plywood, tiles, that kind of space, because again, a big slowdown we are seeing there that's not changing in the near future. And the third space has been IT services, where we would like to see some growth coming back in the current results before we add it to the model portfolio.
Right, Abhay, as I see your underweight portfolio, like you mentioned, you're underweight in real estate. Now, a lot of analysts are penciling in a more upside, come 2025 for the real estate sector. It has done well for itself and there is more upside. It's far from peaking out. What is your take on the real estate sector?
Yeah, I think real estate is a very cyclical sector that we have seen go through long cycles of consolidation, and then there is a burst of outperformance. I think the burst of outperformance is largely done because we have had prices go up along with volume sales. So, and I think that is what is very attractive to investors when they see both the pricing going up and the volume going up. But there is a limit to that. I think the pricing in many cases is now becoming unaffordable. The cost of capital, the cost of EMI is becoming coming to a point where it is pretty tough for the buyers. We are seeing a lot of transition to renting rather than buying, and the rental yields are still about, in residential 3 to 4% at best. So I won't be surprised if some of the volume sales, despite the aggressive positioning by the real estate sector, kind of tapers down over the next 6 months. So I think the near-term money that was to be made over the last 2-3 years in the cyclical upturn in the real estate industry has been made, and now there will be some consolidation. So that's the reason.
If you like this video, then like, share and subscribe to ET Now.